Out of all the major retailers in America, Target is currently facing some significant challenges. Recent data reveals that even its top executives acknowledge the alarming issues plaguing the company, and these problems are seriously impacting its financial performance. Over the past year, Target has seen an unprecedented 90% decline in profits. Unfortunately, their strategy to raise prices in 2023 to recover these losses is backfiring. Customers are not showing interest in purchasing 60% of the items in Target's inventory. Furthermore, the remaining 40% has become considerably more expensive this year, causing people to opt for other retailers for their everyday shopping needs. Target's sales continue to disappoint, and both investors and major financial institutions are skeptical about the chain's prospects for improvement in the near future. The harsh reality that no one seems willing to address is that Target is rapidly deteriorating before our eyes, and its decline may occur sooner than anticipated. In today's video, we'll uncover the details, but before we dive in, we kindly request your support by giving us a thumbs up and subscribing to our channel to stay updated on our future content. It's been over 23 years since Target faced such an extended period of losses. Even during the early 2000s, when financial markets were turbulent, the retailer didn't suffer losses as steep as those seen in 2022 and 2023. Last year, Target experienced financial setbacks in all 4 quarters, with profits plummeting by 49% in the first quarter, a staggering 90% in the second, 54% in the third, and 52% in the fourth. Both in-store and online sales declined, despite the company's efforts to clear out excess inventory by offering substantial discounts. This year, the challenges have become even more formidable, as customers are tightening their belts due to a weakening overall economy. What makes matters worse is that the merchandise categories that typically perform well for Target, such as apparel, accessories, and home goods, make up over 60% of their inventory. In simpler terms, the company has lost 60% of its potential sales in these crucial categories. This situation is causing growing concern among executives, retail industry experts, and even Walmart's former CEO, Bill Simon. During a recent interview with CNBC, Simon remarked that retailers like Target are facing significant difficulties, as the economic downturn is likely to have a lasting impact on discretionary spending. Stores in this market must stand out by offering products or services that are in high demand. Chains that primarily sell non-essential items rather than essentials, like food, may face difficulties in keeping up, as Simon pointed out. Just a few months ago, Target's EVP and Chief Growth Officer, Christina Hannington, observed that housing, energy, and food costs now consume a larger portion of American spending than ever before. Unfortunately, Target wasn't well prepared in terms of inventory when this crisis began. As consumers allocate a greater portion of their budget to groceries, sales in categories like home goods and electronics, which make up almost 2/3 of Target's product range, dropped by 7 to 9% compared to the same period last year, according to Hannington. She also noted that customers are increasingly seeking promotions and spending less on regularly priced items. Even though around 39% of Target's offerings were in the grocery category, the company didn't see significant growth in grocery sales in 2023. In fact, after a modest 1.7% increase in January and a 0.8% increase in February, grocery sales declined by 0.7% in March and 0.9% in April, resulting in a meager 0.9% overall increase in food sales for the entire quarter. This may be due to a misstep in Target's pricing strategy. While its discretionary items were already being sold at discounted prices due to an oversupply, the company decided to introduce new price increases in the one category where it remained profitable. Unfortunately, customers did not react positively to these price changes. Within a year, Target's grocery prices surged by an astonishing 21%, according to data from Go Banking Rates. In comparison, Walmart increased its food prices by 27%, but this change occurred over 2.5 years, and Walmart's initial prices were lower than Target's, giving them more flexibility. It appears that Target may have pushed its customers a bit too hard. Prior to this, the company had already passed on higher operational costs to consumers in 2021 and 2022. In a Reddit discussion about price hikes at Target, one shopper expressed their frustration, describing prices at the retailer as insane. They acknowledged that inflation was a factor, along with other issues contributing to price increases. But what stood out was their struggle to afford basic purchases that were reasonably priced just a year ago. They noted that the price of watermelon, for example, had gone up to $9.99, whereas it used to be as low as $3.99 during promotions, and typically no more than $4.99. This individual shared that Target's grocery prices no longer offered the affordability seen at their competitors like Costco, Aldi, and Walmart, which consistently provide better value and deals to their customers. Another common issue raised by Target shoppers is the frequent presence of empty shelves in the grocery section. Customers often find the quality of fruits and vegetables to be questionable, and some products seem to vanish from the stores without ever returning. The decision to raise food prices again couldn't have come at a worse time. It coincided with other retailers' efforts to keep inflation in check in order to attract more consumers and boost their profit margins. Rather than prioritizing the needs of its existing customer base, Target is setting its sights higher. The retail giant is actively trying to appeal to more households earning over $150,000 annually. In 2019, only 14.8% of Target's customers fell into the upper middle class bracket. Today, that figure has risen to 19.6%. While these customers tend to spend more per sale, generating larger transactions compared to lower middle class and low-income families, they alone are not enough to resolve Target's financial challenges. Ultimately, Target is a mass retailer meant to serve consumers of all income levels, a fact that is sometimes overlooked. One prominent example of this oversight was its unsuccessful holiday partnership with the luxury department store Neiman Marcus. The Neiman Marcus collection failed to make a significant impact, primarily due to Target's pricing strategy. Furthermore, the ongoing challenge of reliably stocking its stores with food and groceries, essential categories that bring repeat customers, suggests that the company isn't taking the necessary steps to address its current issues. Even Target's CEO and chairman, Brian Cornell, have acknowledged that their customers are feeling the pinch of the 2023 price increases. "We have a customer base dealing with persistent inflation for several quarters now. They're shopping more cautiously, sticking to a budget," Cornell stated. With inflation rates continuously eroding their purchasing power, many consumers have resorted to borrowing or dipping into their savings to manage their weekly expenses. However, these options are becoming increasingly limited for many consumers, according to Cornell. As a result, our customers are becoming more price-sensitive, paying closer attention to promotions, and hesitating to make full-price purchases. CFO Michael Fidelka also mentioned during an earnings call, "Even though the pandemic is receding, we are still facing a high level of uncertainty and volatility as the world adjusts to a new normal." At present, if Target hopes to achieve its modest sales forecast for 2023, it must boost sales during the upcoming back-to-school and holiday shopping seasons. However, investors and financial institutions lack confidence in the retailer's ability to improve results, especially after disappointing first-quarter performance. J.P. Morgan downgraded Target's stock due to its high exposure to potential financial losses in the second half of 2023. This triggered a significant sell-off, causing Target's shares to drop by half since their peak, as reported by MarketWatch. "We believe that the consumer is experiencing a broad weakening, with spending shifting away from goods, which make up a significant portion of Target's sales," noted J.P. Morgan analyst Christopher Horvers. This shift could continue into the back-to-school season and extend into the holiday season due to consumer pressures and recent controversies surrounding the company. "This may lead to a decline in Target's foot traffic," he added. Target was already losing market share, and these challenges might persist into the second half of the year. Adding to these challenges, Target's CEO, Brian Cornell, anticipates that organized retail crime could result in up to a $500 million increase in stolen and lost merchandise this year. This would push the total loss, known as shrink in the retail industry, to well over $1 billion. Additionally, like the rest of the industry, we are grappling with a growing financial challenge stemming from inventory shrinkage, which has surged by hundreds of millions of dollars compared to the previous year. Target, along with other retailers, has witnessed a substantial increase in theft and organized retail crime impacting its operations. Target's total shrinkage was approximately $400 million in fiscal year 2021, and it escalated to $736 million in 2022. If the expected $500 million increase indeed occurs in 2023, it would result in a staggering three-year total of $2.4 billion. This is a significant financial hit for Target, directly affecting the company's bottom line. Therefore, it should come as no surprise if the chain announces further store closures in the months ahead. Already in 2023, Target has shuttered 49 stores across Maryland, Virginia, Minnesota, and Pennsylvania due to the rising incidence of stolen merchandise over the past couple of years. At this point, financial analysts are expressing concerns that the company's decline may happen sooner than anticipated. Douglas A. McIntyre, co-founder, chief executive officer, and editor-in-chief of 24/7 Wall Street, highlighted in a recent analysis that Target has become the poorest performing retailer in America this year. However, given Target's size and sophisticated operation, one would expect it to outperform these third-tier companies. Unfortunately, as McIntyre emphasized, Target has not lived up to these expectations. The most recent quarterly data from Target reveals that comparable store sales in the first 2 months of the second quarter were only a quarter of what they were in the same period last year. All financial indicators have fallen significantly short of expectations. In the past year, Target has struggled to generate profits. Management's projection of low to mid-single-digit revenue growth for its 2023 fiscal year was yet another disappointing revelation. The company appears to be facing internal challenges, and if it doesn't address these issues promptly, it could face a severe crisis, mirroring the fate of many other retail giants that disappeared from the market. It would be a regrettable outcome for such a beloved retailer, but the retail industry is fiercely competitive, and while Target faces difficulties, its competitors are rising to the occasion and improving their performance.